You open your phone. Someone in your feed is talking about their portfolio. Up big this year, they say, casually, like it's nothing. So you open a brokerage app for the first time, and the screen greets you with a wall of words that feel like a different language. Terms like dividend yield, volatility, PE ratio, and bear market stare back at you like something written in code. You stare at it for a few seconds, then you back out, quietly telling yourself you'll come back to it once things make more sense. Here's the problem: later rarely comes. Stock market vocabulary was never designed to be simple. It was designed to sound complicated. And for most of history, that was on purpose. There was a time when buying a single share meant going through a broker who charged you a fixed fee no matter what, a fee only the wealthy could really afford to pay. But here's what I want you to notice today. The words are complicated. The ideas underneath them are not. A stock is just a small piece of a company. A dividend is just a payment. A bull market is just a long stretch of rising prices. Once you know what the words are pointing to, the fear disappears. So today we are going through 100 stock market terms, not 100 definitions to memorize, 100 locks and the keys that open each one. Quick note before we start. This is for education, not personal financial advice. Let's begin with the first question every beginner actually has, even if they've never said it out loud. That's section 1, and it holds 11 of our 100. What are you actually buying when you buy a stock? Section 1. What are you actually buying? A stock is not a symbol on a screen, and it isn't a lottery ticket either. It's ownership. When you buy a single stock, you own an actual sliver of a real functioning business. Here's the mental shift most beginners never make, and it's the one that separates people who build wealth from people who gamble. You are not making a bet on some ticker symbol bouncing around a chart. You are backing an actual company. You're saying, I expect this business to be worth considerably more down the road than it is this very moment. That's an entirely different mindset than just watching a number blink on a screen. The unit of that ownership is called a share. Say a business has been divided into 500,000 shares in total, and you personally hold 200 of them. That works out to owning roughly 0.04% of the entire company. Whoever holds shares like that, including you, is called a shareholder. Not every share is the same kind, though. Common stock is the version nearly every beginner ends up owning. It gives you a claim on future profits and typically a vote on major company decisions, but nothing about the dividend is guaranteed. Preferred stock trades that vote away. In exchange, you're generally first in line for a steadier, more predictable payout, and you can only buy shares at all if the company has chosen to sell them publicly. A public company has opened its ownership up to anyone willing to buy in through the open market. A private company hasn't. Its ownership stays locked inside a small circle of founders and early investors, which is exactly why you can't simply decide to own a piece of one. So once you own a share, how do you actually make money from it? Two ways. Capital appreciation is a technical name for the price of your share simply going up. Buy at $100, sell later at $150, and you've made $50. The second way is the dividend, and it trips up more beginners than almost anything else in investing. So let's slow down here. Say you own 100 shares and the company pays a $1 annual dividend per share. That's $100 a year landing in your account just for holding the stock. Sounds like free money. It isn't quite. Here's the part almost nobody explains up front. There's a specific cutoff day tied to every dividend. The ex-dividend date, the day that decides whether you actually qualify for the upcoming payout at all. On that ex-dividend date, the stock price typically adjusts downward by roughly the dividend amount, all else being equal. A $50 stock paying a $1 dividend tends to open that day around $49. You haven't gained anything extra, and you haven't received free additional value either. The company has simply converted some of its own value into cash and handed it directly to you. So what's the actual point of a dividend then? It forces a company to hand real cash back to its owners instead of quietly sitting on it. We'll come back to the trap that high dividend numbers can hide a little later on. Put everything you own together, one stock or 30, and you get a portfolio. Simply the full collection of what you hold. So now you know what you're actually holding, but you may be wondering how you'd even go get one. Section 2 answers that, and it's our biggest stretch yet. 19 of our 100, everything sitting right there on the screen the moment you open a brokerage app. Section 2, what do you see when you open a brokerage app? Let's actually walk through the screen, piece by piece, the way you'd see it the first time you open an app. Start with finding the stock itself. Every company trades under a brief, unique code, its ticker symbol, essentially a nickname the market uses instead of spelling out the full company name every time. That trading happens on a stock exchange, a marketplace where buyers and sellers actually meet. To get access to one, you need a brokerage account, a platform that gives you a direct line into the market. Some brokerages still charge a commission, a small fee for executing your trade, though many today charge none at all. Next, timing. The market doesn't run around the clock. There are official market hours, typically 9:30 in the morning to 4 in the afternoon, Eastern Time. Trading before that window opens is called pre-market trading. Trading after it closes is called after-hours trading. Here's what matters about both. Fewer people are actually trading during those windows, so prices can swing more sharply on far less activity than you'd see during the regular day. At the very start of the session, you'll see the opening price. At the very end, the closing price. And in between, there's simply the stock price moving continuously as trades happen. You'll also often spot the 52-week high and low sitting nearby, simply the top and bottom prices a stock has reached at any point over the past 12 months. It's useful context, but neither number is a buy or sell signal on its own. Now, how alive is a given stock really? Trading volume tells you it's the number of shares that change hands over a stretch of time. High volume means a lot of activity. Low volume means the opposite. This connects directly to something that matters more than most beginners realize: liquidity. Liquidity tells you how easily a stock can change hands in either direction without your own order dragging the price along with it. Picture trying to sell a rare, oddly shaped antique in a town where almost nobody collects antiques. It might genuinely be worth something, but finding someone ready to pay a fair price for it right now is a real struggle. That's illiquidity. A widely traded, popular stock almost never runs into that problem. Here's where the screen gets genuinely confusing for a first-timer: the bid and the ask. A bid is the top price some buyer out there is currently offering. An ask is the bottom price some seller is currently demanding. Whatever gap sits between those two numbers is called the bid-ask spread, and it costs you real money on every single trade, whether you notice it or not. Here's exactly how. Say a stock shows a bid of $32 and an ask of $32.15. Buy 200 shares at the ask, and you'll pay $6,430. Try selling those same shares back immediately, and you'll only collect the bid price, $6,400. $30 is simply gone, and the stock itself never even moved. Last piece, how you actually place the trade. A market order tells your brokerage, execute this trade immediately at whatever price the market is offering right now. Here's the risk that carries. Imagine a stock sitting at $75 when you submit an order for 50 shares. Right as your order fires, a sudden wave of buying interest pushes the price to $76.50 before your trade actually fills. You've just paid an extra $75 for shares that were $75 only moments earlier. A limit order avoids that entirely. You name the exact number you're willing to accept, and the trade won't execute for anything worse than that. The trade-off is that if the stock never reaches your number, you simply don't get filled, and a stop order is meant as a safety net. You set a trigger price below the current one, and if the stock falls to it, the position sells automatically. One important correction here, because this is exactly where beginners get hurt. A stop order does not guarantee the price you set. Once it triggers, it typically becomes a market order, which means in a fast, chaotic drop, it can execute well below where you thought you were protected. So now you can actually read the screen, but one number on it is going to confuse you more than any other. That question opens section 3. 8 terms explaining why one company trades at $10 a share and another at $500. Section 3. Why is one stock $10 and another $500? Here's the trap almost every beginner falls into, and it's a completely reasonable one to fall into. They see a $10 stock and assume it's cheap. They see a $500 stock and assume it's already expensive, maybe already had its run. Neither assumption is safe, and here's the single number that explains why. Every company decides on its own how many pieces to divide itself into. That total is called shares outstanding, and it can be almost any number the company chooses. Picture 2 companies, both worth exactly $1 billion altogether. Company A has issued 10 million shares. Divide 1 billion by 10 million and each share costs $100. Company B has issued 100 million shares. Divide that same 1 billion by the larger number and each share costs only $10. Same company value underneath. Completely different price tag per share, purely because of how finely it's been sliced. The $10 stock isn't cheaper, it's just been cut into more pieces. This is exactly why the number that actually matters is market capitalization, market cap for short. Get that figure by multiplying the current share price against the total shares outstanding. 10 million shares priced at $50 each gives you a market cap of $500 million. What the market believes the entire business is worth right now, today. Companies get grouped by this number into rough size bands. Depending on which index provider you're looking at, you'll typically hear small cap for the smaller, higher risk end, mid cap for the tier above that, large cap for the biggest, most established names, and mega cap for the true giants sitting above even that, a small handful of names you'd already recognize without being told. These bands shift depending on who's drawing them and move as the market itself moves. So treat all of them as general zones, not fixed law. Now, say you can't quite afford one whole expensive share. That's what a fractional share solves. Many brokerages now let you buy a slice of a share, $10 worth of a $500 stock, instead of requiring the whole thing. Companies can also change their own share count after the fact. A stock split multiplies how many shares you hold while shrinking the price per share by the same proportion. So the total value sitting in your account never actually changes. Own 100 shares at $100 and the company splits 2 for 1. You now hold 200 shares at $50. Nothing actually changed except how finely it's sliced. Let's bring in a small company we'll follow for the rest of this video. Alderbrook Coffee Company. Say Alderbrook has 10 million shares outstanding, priced at $10 each. That gives it a market cap of $100 million. Hold on to that number. We're coming back to it soon. You now understand what a company is worth today, but prices never sit still, and Section 4 picks up right there, 10 terms on what actually pushes them in either direction. Section 4, what makes stock prices rise and fall? At the simplest level, it comes down to supply and demand. More buyers than sellers, the price climbs. More sellers than buyers, it falls. But the real question is what genuinely drives someone to become a buyer or a seller in the first place. Sometimes there's real logic behind it. Say a company posts strong profits and the price responds accordingly. Sometimes it's closer to pure emotion, and that collective emotion has its own name. Market sentiment, how optimistic or fearful investors are feeling as a group, often with very little connection to the actual numbers underneath. That emotion shows up physically as volatility, how sharply a stock's price swings. High volatility means big, fast moves in both directions. Low volatility means calm, predictable movement. Now, the conditions that emotion creates. A bull market is a sustained stretch of rising prices, generally measured as a climb of 20% or more from a recent low. A bear market is the mirror image, a drop of 20% or more from a recent high. A market correction is smaller and more temporary, typically around a 10% pullback that doesn't necessarily break the longer trend. Further out on the extreme end sits the market crash, a sudden, brutal plunge usually set off by panic or some kind of shock event. And a market bubble is what happens when a price gets pushed miles above what the underlying business could ever actually justify, purely on hype and speculation. Bubbles eventually burst and usually hard. Here's the emotional miscalculation that quietly wrecks more beginner portfolios than almost anything else. A bear market feels far worse than a bull market feels good. Watching your account drop 30% over a few months is genuinely painful, in a way that gaining that same 30% slowly over a year and a half simply isn't. That imbalance has real measured consequences. Over the 20-year period ending in December of 2024, the average equity investor earned about 9.24% annually, while the S&P 500 itself returned 10.35%. That gap exists almost entirely because people sell near the bottom, out of fear, and miss the recovery that follows. There's also a slower, quieter force pushing on prices from underneath, the wider economy itself. Inflation is simply prices across the economy climbing over time. So every dollar you're holding won't stretch quite as far as it once did. And it's a big part of why leaving money sitting in cash long term can actually cost you. A recession describes a sustained, broad slowdown in economic activity, and it tends to drag corporate profits and stock prices down together. Central banks respond to both through monetary policy, mainly by raising or lowering interest rates, to either cool an overheating economy or support a weakening one. And those rate moves ripple straight through to how every stock in the market gets priced. You now know what makes a price move in the short term, but eventually the market has to answer a much harder question about any given company, and that's Section 5, 13 terms on whether the actual business is any good. Section 5, how do you judge the business behind the stock? This is the most technical part of the video, so we'll lean on Alderbrook Coffee Company the whole way through rather than jumping between random examples. Start with what a company actually owns and owes. Assets are everything it has. Cash, equipment, property. Liabilities are everything it owes. Loans, unpaid bills. Alderbrook owns its espresso machines and its lease deposits. It also owes money on a small business loan. Where do you actually see this laid out? On the balance sheet, a snapshot of everything a company owns and owes at one specific point in time. Now, what does the business actually generate? Revenue is the total money coming in from sales. Once you subtract everything the business spent to operate, whatever remains is net income, the real profit line. Both of those live on the income statement. Say Alderbrook brings in $100 million in revenue this year, and after every cost is paid, $10 million is left over as net income. How efficient is that really? This is where margins come in. Gross margin shows what survives after just the direct cost of making the product, the beans and the cups themselves. Operating margin goes further, after salaries and rent are paid too. Whatever survives after literally every expense, every tax, and every dollar of interest gets subtracted. That final number is net profit margin, the real finish line. Now let's translate that company level profit into something that matters directly to you as a shareholder. Divide net income by shares outstanding and you arrive at earnings per share, EPS for short. Alderbrook has $10 million in profit and 10 million shares outstanding. That's an EPS of exactly $1. From there comes a number probably more talked about than any other in investing, the PE ratio, or price to earnings ratio, which lines the share price up against EPS to show you what you're actually forking over for each single dollar the company earns. Alderbrook trades at $10 a share with an EPS of $1. That's a PE ratio of 10. You're handing over $10 for every single dollar the company earns each year. Here's a trap. A cheap-looking PE ratio isn't automatically a bargain, and an expensive-looking one isn't automatically overpriced. Picture a regional grocery chain trading at a PE ratio of 8, next to a solar energy company trading at a PE ratio of 32. Instinct says, grab the grocery chain. It looks like the obvious bargain. But if that grocery chain is steadily losing customers to bigger competitors, while the solar company's earnings are compounding fast as demand explodes, the 32 suddenly looks like the smarter price. You're not overpaying for the solar company. You're paying today for where its earnings are headed tomorrow. Now, remember the seed planted earlier about dividends hiding a trap? Here it is. Dividend yield takes what a company pays out per year and measures it against today's share price expressed as a percentage. Say Alderbrook pays out 40 cents a year and trades at $10. That's a yield of 4%. Now watch what happens if the price falls to $5 while the dividend itself stays exactly the same. The yield jumps to 8%. That looks exciting until you realize the yield only rose because the price is falling, quite possibly because the business is struggling, not because you're suddenly earning more. Last piece here, and it's one most beginners have never even heard of, the stock buyback. This is a company using its own cash to repurchase its own shares, which it can then either retire completely or simply hold on to as what's called treasury stock. Say Alderbrook repurchases 1 million of its 10 million shares and takes them out of circulation for good. 9 million now remain. If you personally held 100,000 shares, you owned exactly 1% of the company before that buyback. Afterward, that same 100,000 shares represents just over 1.1%. Your slice of the company got bigger without you buying a single additional share. And since profit is now divided across fewer shares, EPS can rise too, even if total profit never actually grew. But here's the correction worth sitting with. A buyback does not automatically create new economic value. It reshuffles ownership. It does not, by itself, make the underlying business worth more. You now know how to judge whether a business is genuinely sound, but the market has labels for different types of companies: growth, value, blue chip, defensive, and Section 6 sorts through all 6 of them. Section 6, what type of stock are people talking about? Let's take these as 3 contrasting pairs, genuinely easier to remember than 6 standalone definitions. First, growth versus value. A growth stock is expected to expand quickly and usually reinvest every dollar of profit back into the business instead of paying dividends. A value stock looks inexpensive relative to its own fundamentals, the bet being that the wider market hasn't recognized its true worth yet. Neither label is permanent. A company can shift between the two over time. Second, cyclical versus defensive. A cyclical stock rises and falls with the broader economy. Think airlines or construction, thriving in a boom, struggling in a downturn. A defensive stock holds up regardless of the economic weather. Companies selling things people need no matter what, like groceries or electricity. Third, and it's not a true opposite, but it's memorable: blue chip versus penny stock. A blue chip is large, established, and widely trusted, the kind of name that's been reliable for decades. A penny stock sits at the far end of the spectrum: low price, thinly traded, highly speculative, and vulnerable to manipulation. Beginners are often drawn to them because turning a $1 stock into a $2 stock feels more achievable than turning a $100 stock into $200. But that reputation for risk is well earned, and investors in penny stocks routinely lose most or all of what they put in. You now know how to read a single company from every angle, but at some point you may realize picking individual companies isn't the only option available to you, and Section 7, 16 terms strong, is where we find out whether you actually have to. Section 7, do you have to pick individual stocks? Here's some genuine relief. You don't. Start with the baskets. A mutual fund pools money from many investors into one shared portfolio. Some are actively managed with a professional manager deciding what to buy and sell inside it, while others simply shadow an index rather than attempting to outperform it. An ETF, short for exchange traded fund, behaves like a single stock on the exchange, meaning you can jump in or out anytime during trading hours. Unlike a traditional mutual fund, which only gets priced and traded once each day after trading has wrapped up for the session. And an index fund is really a strategy, not a structure. It simply aims to match a market index rather than beat it, and it can be built as either a mutual fund or an ETF, which brings us to what an index actually is. A market index is a defined basket of stocks meant to represent a slice of the market used as a benchmark. The S&P 500 tracks 500 leading large American companies selected to represent the U.S. stock market as a whole, and it's usually the number people actually have in mind whenever they casually mention how the market performed on a given day. The Dow Jones Industrial Average tracks a much smaller group, just 30 companies using an older pricing method. Cost matters here more than most beginners expect. The expense ratio is simply what a fund quietly charges you every single year, shown as a small percentage of whatever you've invested in it. Here's why a small sounding number becomes enormous over time. Invest $10,000 for 30 years at a real return of around 7% before fees. With a fee of just 0.1%, you'd end up with roughly $74,000. With a full 1% fee instead, you'd end up with roughly $57,400. That's a gap of well over $16,000 on a single $10,000 investment, purely from fees quietly eating into your returns year after year without you ever noticing it happening. Beyond stocks entirely, a bond is essentially a loan you make to a company or a government, paid back with interest over time. A Roth IRA isn't an investment itself. It's a type of account, one where your money grows and can be withdrawn tax-free in retirement as long as you follow the rules. A hedge fund sits at the far end of the spectrum, a pooled fund running more aggressive strategies in pursuit of bigger returns, generally reserved for wealthy investors who can absorb the extra risk that comes with it. And cryptocurrency, coins like Bitcoin or Ethereum, is worth a mention here too. Not really a stock market term at all, but a separate asset class beginners often lump in with investing in stocks. It trades independently of any company's earnings or any government's currency, entirely on its own supply and demand. Now, how do you actually manage a mix of all these pieces? Diversification means spreading your money across different companies, sectors, and asset types so a single loss doesn't sink the whole portfolio. A sector, by the way, is simply a slice of the economy: technology, healthcare, energy, and so on. And different sectors tend to lead or lag one another depending on where we are in the economic cycle. Here's a mistake worth naming directly. Owning 10 different technology stocks is not real diversification because that's still just one sector wearing 10 different names. This gets at something with an actual technical name. Systematic risk is the risk that hits the entire market all at once, a recession, for instance, and no amount of diversification protects you from that kind. Unsystematic risk is the risk specific to one company or one sector, and that's the kind diversification can genuinely reduce. Asset allocation takes this further. It's how you divide your money between categories entirely: stocks, bonds, cash, based on your own goals and comfort with risk. So now you know what you can actually own. The next question is entirely about you, and it's exactly what Section 8 covers: 11 terms on how you're going to behave once your money is actually in the market. Section 8, what kind of investor are you? Start with time horizon. Investing means buying with a multi-year mindset, betting on where a business will be years from now. Trading means operating on a much shorter clock, days, weeks, months, trying to profit from the price movement itself. Next, management style. Passive investing simply means buying a broad fund and sitting on it, letting the whole market do the work instead of hunting for individual winners yourself. Active investing means the opposite: deliberately choosing specific stocks or timing at entries and exits in an attempt to beat the average. Here's a number worth sitting with. Over the 15-year period ending in December of 2025, nearly 90% of actively managed large cap funds underperformed the S&P 500 itself. Buy and hold is the classic passive approach in practice. Buy good businesses and simply let time and compounding do the work. That last phrase deserves its own moment because compound interest is the entire engine behind that strategy. It means you earn returns not just on your original investment, but on the returns it already generated too. Put $10,000 in at 10%, and after year one, you have 11,000. Year two, you earn 10% on that larger 11,000, landing at 12,100. Year three, 10% on that even larger number, and you're at 13,310. Each year's gain is bigger than the last purely because the base it's growing from keeps getting bigger too. Now, how the money actually enters the market. Dollar cost averaging means investing a fixed amount at regular intervals, no matter what mood the market happens to be in that particular week. Market timing means trying to predict the single best moment to buy or sell, and it's something study after study shows even professionals struggle to do consistently. How do you actually evaluate what you're buying? Fundamental analysis studies the real business itself, its revenue, its management, its competitive position. Technical analysis studies price charts and patterns instead, trying to forecast where a stock is headed purely based on how it's moved before. And finally, your own tolerance for the ride. Beta measures how sensitive a stock has historically been to the market's overall movement. Sitting right at a beta of 1, a stock tends to rise and fall step for step with the broader market. A beta above 1 swings harder in both directions. It's a measure of past sensitivity, not a guarantee of future results. You now understand how you might choose to behave. But sometimes the company itself is the one taking action, and Section 9 covers exactly that. What happens when a company goes public or someone on the inside starts trading? Section 9, what happens when companies and insiders transact? An initial public offering, or IPO, is the moment a private company opens its doors to public shareholders for the very first time, offering ownership up to everyday investors. And then there's insider trading, buying or selling based on material information that hasn't been made public yet. If an executive knows bad earnings are coming and sells before the news breaks, that's illegal. Ordinary insider buying and selling is completely legal as long as it's properly disclosed. And watching what insiders do with their own money can sometimes be a genuinely useful signal. You now understand how companies themselves move. Section 10 closes things out, and some of the most exciting sounding words in investing are also the ones capable of costing you money the fastest. Section 10, which terms can cost you money quickly? Short selling means borrowing shares, selling them immediately and hoping to buy them back later at a lower price to return them, pocketing the difference. It sounds clever until you consider the downside. If the stock rises instead of falls, your potential loss has no ceiling because there's no limit to how high a price can climb. Margin trading means using money loaned by your brokerage so you can control a bigger stock position than your own cash could cover on its own. It amplifies everything, your gains and just as easily your losses, while interest quietly accrues on the borrowed money the entire time. A capital gain is simply what you pocket when an investment sells for more than what you originally put into it. And the timing of that sale matters enormously for taxes. Hold the investment for 1 year or less, and the gain is generally taxed as ordinary income. Hold it for any longer than that, even a single day beyond the 1 year cutoff, and it usually qualifies for a lower preferential rate instead. Here's exactly what that gap looks like. A $10,000 profit taxed as short term at a 24% bracket costs you $2,400 in tax. That same profit held just past that 1 year cutoff and taxed as long term at 15% costs only $1,500. That's $900 kept, purely for crossing that line. And finally, the wash sale rule. Sell an investment at a loss, then repurchase that same investment, or something substantially identical within 30 days on either side of the sale, and you generally cannot deduct that loss from this year's taxes. It isn't gone forever. It typically gets folded into the cost basis of the replacement investment, but it won't lower this year's tax bill. You don't need to have every one of these 100 memorized the moment this video ends. What you actually have now is something better: a map, what you own, where it trades, how the price is built, how the business performs, what type of company it is, how the market itself behaves, how you plan to behave inside it, and where the real risk and the real tax consequences live. Go back to the very start. You closed the app because the screen felt like a wall of jargon designed to keep you out. Now, when you see bid, market cap, PE ratio, ETF, correction, or limit order, you don't see a wall anymore. You see a category and a question that word is actually answering. Save this video. Come back to whichever of the 10 sections you need whenever a new term catches you off guard. Before you go, tell me in the comments which one of these 100 terms confused you the most before today.